Danny, I'm gonna go with no hat in this one. Doesn't my hair look
It
not
looks
bad, right?
professional,
My
man.
quarantine haircut, right?
I
Here
like
we
it.
go. So guys, if you end up liking this video, do us a favor and subscribe and like it. It helps us grow. Before we get going, guys, we just want to let you know we started a Discord. We'll put the link in the descriptions below. It helps Danny out so he's not texting all of his buddies about this and that and the other thing, and just kind of helps kind of get everything in one little space. And we have different channels for different types of trades, so it seems to be very useful. So if you'd like to join that, go ahead. Secondly, in this video, we're going to talk about shorting stocks, which is something that I am kind of afraid to admit that I didn't really know what that was. So Danny's going to, I see you laughing over there, Danny. So Danny's going to go into depth about this and just talk about shorting stocks and all that sort of stuff. So Danny, go start saying words about stuff.
All right, so this is a chart for the last year for Lululemon. As you can see, it took quite a drop in March with the whole sell-off, but actually hit a new all-time high 3 days ago, 324. This is the kind of stock I'd look to possibly be shorting and looking for the downside to make some money on that. So on Thinkorswim, if you wanted to sell and short an actual stock, you would just click the bid, and that'll create this entry here on the bottom. You're going to want to make sure the quantity matches what you're looking to do. Default is 100 shares, which in Lululemon's case is almost a $30,000 position. So you might want to do less than that. So I put 10 here, and then you just make sure that the price is agreeable with you, and that's the actual all-in obligation if you wanted to sell 10
Can
shares.
you, if you wanted to short one share, can you do that?
Yeah, you got to make sure. Okay, so the first thing actually I should discuss, when you're shorting shares, you do need to have margin enabled on your trading account, because in essence, when you short a stock, you're borrowing from the broker. And you can't do that on a cash account. You need to have margin enabled. And then from there, you'll see Thinkorswim. Even though this is only on one share, it's a $295 obligation. They actually require excess of that, $384. Just on the side, to err on the side of caution in case the shares go up, to make sure that you can actually afford that obligation, and you don't end up upside down, and then TD Ameritrade has to like put a lien on your house or something like that. So on one share, $295 risk, they actually do require $384. So I wouldn't do too much of this, just in case, because this is a high price stock. So on 10 of them, you're looking at 38.48 obligation, which is manageable.
Okay.
And then that's what the risk profile would look like. If Lululemon got back to 200 or so, you'd be looking at about $1,000 almost profit on the shares. So the upside's pretty limited here. It's right near an all-time high in this environment, and they're not really making a lot of money, and I don't think they will anytime soon. So I wouldn't be surprised if the shares end up back below 200, probably around this range of like 160 to 180 by the end of the year. And then
Okay.
you'd be looking at.
Do you have to set up a limit order to do this?
You can do a market order. I just wouldn't. You want to do limit orders always. Market orders kind of just like setting yourself up to get taken.
So if you wanted to set up a limit order, you obviously want it to be on the high end of the day or the month or
Yeah.
whatever.
So if you're patient with it, let's say you don't want to just chase it because it did drop quite a bit, you could just put a limit order into to short it at, let's say, like 302 or something. And if it gets there, you'll be short that quantity of shares. And then from there, just look to see where you want to get out, whether you want to get out near the previous high at 265 or wait at that point. I try and tell most people to do more than one share so that you can get out of at least a little bit of it as it becomes profitable. So 10's decent, because let's say you're up and it's at 260 or so, you could close out half the position and lock in some of the gains. Well, where with one share, you're all in or you're all out.
Right. Okay.
10's more comfortable for most people. It's still not a huge obligation at just under $4,000. And it gives you that flexibility to get in and get out of it a little bit as it goes in your favor. You can short pretty much almost any stock, even the S&P. When we had that call with your buddy the other day, and I think it was right around this level actually, right? It was the S&P itself was at 320 or so. Had you just even shorted that, it went below 300 on Friday. So you could have made, that's solid. $20 on a $320 risk. That's like a 8% return in like 2-3 days, basically. So you can short anything. The bigger the better, so that you don't have that crazy upside risk. That's why I bring up Lululemon. You don't want to short a small company that could get bought out, and then you end up with like really bad news when you wake up in the morning at that point.
Then what about for setting a stop loss for this?
You got to be wary with stop losses because the market's so volatile, but you can put in a stop loss, stop limit or stop market. And then basically if the stock gets above that price point, you're going to walk out at that point and just close your trade out for a loss. So it's a good way if you don't have the time or the, just the patience to be watching the market regularly. You just put in an automated order on both sides. You can actually put in a limit order to close out at a profit and then have also attached a stop limit loss so that you have that bracket already. And if you're up 10% or if you're down 5-10%, you just get out automatically at that point.
If you go short on $1,000 stock and it goes down 100, is your profit still 100?
Yeah.
So there's no, because you were saying there's more risk doing this though.
Yeah, so it's the profit loss will change dollar for dollar the same whether you're long 100 shares or you're short 100 shares. It's just inverse where the stock goes up, you lose money if you're short as opposed to making money. The difference is that the stock can double, and when you buy a stock, it can only lose 100% of its value. So to keep the numbers
okay.
like smaller, you can short a $10 stock. If it goes to zero, you have made $10. Your max gain is always 100% when you short a stock. But if it goes to 30, you will have lost 200%. So you have to be careful. Yeah,
I got you. Okay,
that's where you can lose a lot more. So that's why I only caution people to short larger companies, so it's less likely to get bought out, and less likely to go up exponentially like that, where you lose a crazy amount of money. So yeah, the actual safest way is actually the biggest stocks at that point. So if Apple looks like it might go back down a little bit, it's a lot less likely for Apple to go up 100% than it is for Lululemon or a smaller tech stock to go up 100%.
Okay.
Or an Amazon or the rest of them. So.
What about a screener through FinViz? Would you use that to find potential shorts?
Yep. So let me set it up here. Yeah. So right off the bat, the default, just avoid anything smaller than 300 million. And then what you're going to want to look for is a ridiculous outperformance, basically. Well, you need to be able to short it. So that's a good requirement to put in there.
Oh, so yeah, you're also mentioning that.
Yeah, so yeah, because there are some stocks that brokers just don't bother. There's not enough demand or enough shares available, so they don't allow for shorting stocks.
Okay.
But yeah, you want to have it so it's shortable, and then beyond that, I try to go after things that are very overpriced as well, so they're more likely to suffer when the market turns south. So something above, let's say like 7 times sales, and then
RSI.
Yeah, we're going to go with performance. So rather than just RSI, so at least for the month, you want something that's up a lot, or at least for the quarter, some sort of outperformance where it's exaggerated, So let's just start with something pretty aggressive. Stocks that are up at least 100% in the last year, and then we'll sort it by market cap. So NVIDIA is actually one that I actually do like to short. It's a very overpriced, as you'll see from the PE ratio, the price of sales. Trading at 18 times revenue is crazy for a chip company. This is one that easily during the next or during this economic downturn, really, I wouldn't be surprised for this stock to eventually end up going below like 120 or so, literally getting cut by 2/3, just because the valuation is just that absurd. Where even at 67% off, it's still going to be trading at 6 times revenue and still trading at 20 times earnings. And semiconductors do really, really poorly during economic downturns. So it's a shocker that this thing hit a new all-time high 2 days ago, basically. So this is one that you could look at shorting. Just obviously play it small, maybe 10 shares max, and yeah, I would look to cover at least 250 or probably below $200, where you look to buy it back, and that's your difference. The difference is your profit at that point. So if you shorted it, keep the numbers round, 350, and you get out at 200, you will have made $150 per share that you shorted. So yeah, that's a basic screen I would go with. Just to look for stuff that's overpriced and has done very, very well. DocuSign's on there. There's a lot of these that you just got to be wary, because just because they're very overpriced doesn't mean they're suddenly going to go down either.
Right.
So stocks can be irrational. Like Tesla's a perfect example where it's ridiculously overvalued, but yet it hit a new all-time high 2 days ago. So they can continue like that for a while. So I typically will play them smaller, and just you have to be patient with it. Eventually, reality and fundamentals matter, and you'll have that huge downdraft in value. And that's where you look to close out at that point.
Is there a length of how long you should be holding on to something you're shorting?
So you got to be careful with that. As long as you're shorting stocks that aren't that heavily in demand to short, or they're very readily available on Amazon, Apple, for instance, it might cost you like 1% a year to be short. So then you can have the patience to wait it out, especially if you expect it to go down 10, 20%. But Tesla, Nikola, Zoom, a lot of these popular stocks that people are shorting, they are costly to short. So that is a huge red flag that you got to be wary of.
So as long as you're in and out of these trades within a
Quickly.
couple days or weeks,
Yeah, it won't matter. Yeah.
okay.
If it's heavily shorted. If it's not like an Amazon or Apple, you could stay short that thing and they're probably going to charge you less than 1% a year. So it's not a big deal. It just depends on the availability and demand for those short shares.
Cool.
Yeah.
Danny, I've learned something new today.
Yes. It's a good way to balance your exposure. So on a day like last Thursday where the market was tanking, it's one of the things I try to do, which is called relative value, where you try and buy undervalued stocks you think will do well long term, and then you try and short overvalued stocks that should underperform over the long and intermediate term. And on a day like Thursday, ideally, theoretically, the undervalued stocks will not decline as much as the overvalued stocks. So then your portfolio should be at least somewhat hedged, is what the term is for it. So that ideally, like a Lululemon should go down 10% for every, like 5% that a Principal Financial Group or AT&T, Verizon, the safer undervalued names would go down on a really big downdraft.
All right, guys, thanks for watching this video. Until next time, we'll see you. We'll see you later. Danny, what you got?
Make money.
Make money.